Hi, this is Steve Hutchinson with Hutchinson Family Offices with our monthly video update. And what I want to do today is bring you up to date on our perception of the economy, what's going on with the Fed and the financial markets. First, let's talk about the Federal Reserve. Now, the third quarter ended in our financial markets with a lot of volatility, and we expected that. We've been talking about that all along. We felt that once Labor Day was over, the financial markets were going to continue to be volatile, and pretty much that has worn through. We had a sleepy summer, very low volatility. It was reasonable to expect September was going to be an interesting month. Now, the Federal Reserve continues to be a source of speculation by the media. It is not a source of speculation with us. I'm not saying that we've got the Federal Reserve figured out, but quite frankly, we don't subscribe to a lot of the information that you're hearing about on the various news shows. Bottom line is we'll probably see an interest rate increase in the December meeting. Now, that being the case, that would be a very small rate, and we do not believe at that particular time we'll see a positive reaction by the financial markets. In other words, traditionally, as we move into the month of December, people are doing some tax swaps, they're doing some selling, trying to align their portfolios for tax purposes. And to go one step further, we really don't know who the president's going to be, but of course, it seems that we're going to probably end up with a more progressive tax policy if you read the polls. So the bottom line is that people are going to be a little bit more proactive on the tax planning side. An interest rate increase in December is going to accentuate that. It's going to make that a little bit more volatile. And we're going to see continued strength in the dollar. So this is going to give the Federal Reserve a little bit of a challenge on how to manage this and how to manage this information. They're in a tough spot. They really are. They're just in a very, very tough spot. They've written checks they can't cash. They said they were going to increase interest rates 4 times this year. That's not shown up. Bottom line is we're seeing the Chinese manipulate their own currency against our dollar. We're seeing the dollar continue to grow in strength, which is hampering the economies in Europe and also having a substantial impact on world oil prices. So they're in a tough predicament. So we expect the Federal Reserve to step up, possibly increase rates sometime in December. Now, what does that mean for you as an investor? Quite frankly, it's at these levels, it's a non-event. Now, if we happen to see a regular event where we're starting to see the Federal Reserve increase rates 1/4 point each time they come or they meet or whatever it might be, that could be troublesome. And one of the reasons is that if you look at the election rhetoric that's going on today, there's a lot of money that's being passed out by people. Again, folks writing checks they can't cash. Bottom line is that at some particular point, given a $20 trillion national debt, it's going to be very difficult just for the tax receipts to cover the interest payments. And that's something a lot of us don't really think about. So every time the Federal Reserve incrementally increases interest rates, yes, that increases the rates for savers, but it also increases the cost of the government's price that they have to pay to borrow money. So this is going to have an impact. And so we expect 2017 to be a very volatile year, hanging on every word of the Federal Reserve. And so as we move into the fall, as we get through the fall, November, December, we expect a rate increase, although that rate increase will not be made based on the merits that the Federal Reserve has used. Let's talk about the economy. I think the important thing about the economy is that economic growth is just slow. It's almost loathsome. It could be so much better. But we have a very, very significant layer of bureaucracy not from the government with additional federal regulations that are coming down, both issued by the Department of Labor and other government agencies. We have some significant issues that are facing businesses, whether they want to invest more. We've got companies that are moving their business and their operations outside the United States to escape our corporate tax rates. All of this is having an effect on the economy of our country. Our economy is growing at 1.4%. This is the slowest economic recovery since the Great Depression. And it's very concerning. It's not getting enough press. Now, politically, it's a football. But the bottom line is, we're just not growing as an economy. And if we do not grow at a rate of 2 to 3%, we are not going to be able to generate the high-paying jobs, the good jobs that this economy and the people in this country want to see. So it doesn't matter who gets in the White House, we're going to spend more money. And unfortunately, the economy is going to basically continue to contract until we see positive influence out of Washington, out of the bureaucracies to loosen up the business cycles. Also, too, I want to point out that businesses depend heavily on lower interest rates. So somewhat, if you look at the equity markets and you look at the performance we've had in the equity markets, it's somewhat artificial in that the interest rates have somewhat, the false interest rates have created somewhat of a false economy. Now, I believe in 2017, that will come home to roost. And I think it's going to shock a lot of individual investors. And I think we're going to see more volatility and we're going to see some challenges that people are going to face. Are we expecting a collapse? Certainly not. Are we expecting a recession? That's a possibility, but it's not going to be dictated by the financial markets. A recession will come pretty much out of policy, and we'll see how that works. Now, what can we expect for the next few weeks? Well, earnings are starting to come in, and already, as I'm taping this, Alcoa just reported yesterday, stock market drops about 1 or 2%, biggest drop since September. Of course, next month it could go up 1 or 2%. That'd be the biggest increase since September. Earnings volatility is going to plague the market for the next 30, 45 days. So we expect the financial markets to continue to be volatile. We're starting to see a stronger transition into investments that are more income oriented as investors are continuing to see transition into income investment. And so what we expect is that trend to continue, even if the Federal Reserve increase interest rates. As always, we're going to keep you informed. We are very cautious at this particular juncture in the financial markets, and I believe it's very important for you to sit down with your financial advisor and have a serious conversation about the level of risk you're willing to take given what we're looking at in this economy right now. That'll do it for this video. Give us a call at any time. Let us know what we can do to be of help, and have a great day.